Welcome to The Debate. Today we're diving deep into one of the most intense strategic challenges facing China's e-commerce giants, the instant retail subsidy war of 2025. Alibaba, JD.com, and Meituan have collectively poured nearly 200 billion RMB into this fierce battle for market share.
Right, a staggering amount.
Exactly. So, our central question today is, can these companies fundamentally break the long-standing price, convenience, quality, impossible triangle in retail? Or are they simply, masking its enduring presence with tactics that just aren't sustainable? Our discussion is grounded in recent industry reports and detailed financial analyses of their strategies and market outcomes. I'll be arguing that through truly innovative strategies, deep technological integration, and a sharp focus on long-term user value, these companies are indeed redefining the terms of that triangle, achieving, frankly, new and unprecedented balances.
And I'm going to challenge that perspective head on, because despite these massive investments, I maintain that the fundamental trade-offs of the impossible triangle remain as true as ever. I believe current strategies are, largely unsustainable, merely masking underlying economic realities rather than genuinely overcoming them.
Okay, let's get into it. The traditional impossible triangle, that retail axiom stating you can typically only optimize for two of these three crucial elements simultaneously, price, convenience, often meaning timeliness, and quality, is, I believe, truly challenged. Particularly, Alibaba and Meituan are pioneering some really forward-thinking strategies. Alibaba's approach, in my view, represents an ecological reconstruction. Now, this isn't just about defending old territory, it's about actively expanding its entire ecosystem. We're seeing a deep integration of various consumption scenes. You've got Flash Purchase, local life services, travel, and even their fresh grocery chain, Freshippo. They're all converging within the main Taobao app. This isn't just offering more, it's about seamlessly meeting diverse user needs on a single unified platform. A key driver here is what I'd call data asset compound appreciation. Just imagine combining the high-frequency, low-value data from everyday flash purchases, like, say, your morning coffee order, with the low-frequency, high-value data from your traditional e-commerce shopping habits. When you layer these two types of data, the synergy isn't just additive, it's, exponential. Our analysis suggests this combined profile yields more than double the commercial value through significantly enhanced personalized recommendations. And AI and cloud technologies are absolutely central to this. Alibaba's invested 100 billion RMB already and plans an additional 380 billion RMB in the next 3 years. These technologies provide crucial digital solutions for local businesses. They optimize demand prediction, and they create value far beyond simple gross merchandise volume, or GMV, the total value of goods sold. The focus is clearly on increasing user lifetime value, LTV, that's the total revenue a company expects from a customer over their whole relationship, through cross-scenario usage. And that, to me, justifies these initial subsidy investments. Look at Taobao Flash Purchase. It's shown really strong early success, reaching 120 million daily orders and 300 million monthly users in just 4 months. Non-meal retail orders surged over 360%. Management's aiming for 1 trillion RMB in new GMV within 3 years, repositioning Flash Purchase as a core strategic engine. Meituan, on the other hand, is building what you could call an operating system for urban instant commerce, rooted in its execution is king philosophy. And this has resulted in a truly widespread instant delivery network, extensive merchant coverage, and full chain dispatch capabilities, cementing its strong user mindset for local services. It's actively evolving into a life super app, consolidating a vast array of services with a super membership model.
I hear your optimism, I do, and the concept of ecological reconstruction is certainly ambitious. However, I just don't buy that the fundamental, impossible triangle, the principle that you cannot simultaneously achieve optimal price, timeliness, and quality, has been fundamentally broken. I believe it remains a core truth in retail, simple as that. The current subsidy war, while yes, effectively stimulating short-term user growth, merely masks this enduring principle. The sheer scale of subsidies, approaching 200 billion RMB across these three giants, it's frankly unsustainable. This massive cash burn leads to skyrocketing operational costs and, crucially, cultivates very low user loyalty. Consumers, quite understandably, just hop between platforms for the best deal. Once these subsidies inevitably cease, and they will, any perceived price competitiveness will just plummet. We've already seen evidence of this in the financials, haven't we? JD.com's Q2 operating profit margin, a key indicator of how profitable their core business operations are, drastically fell. It went from a healthy 4% down to just 0.3%. That's a massive drop, and it clearly shows the direct impact of this subsidy-driven expansion on their bottom line. Their net profit was nearly halved. Meituan's stock price also plunged 22%, reflecting, I think, significant investor concern about long-term profitability. Moreover, this aggressive competition has already drawn significant regulatory attention. Platforms have been summoned, urged towards more rational competition that signals potential future restrictions on subsidies in what some are calling zero-cost shopping. The inherent trade-offs persist across all players. Take JD.com, for instance. Despite its famously robust supply chain, it really struggles with its historical high premium when it gets dragged into price wars. Sustaining low prices rapidly erodes profit. High timeliness demands extreme fulfillment costs. And quality control for a vast array of goods remains a significant challenge. Its heavy offline investments, like its 7 Fresh chain and the physical JD Mall stores, they're not yet profitable, adding to the financial strain. Alibaba faces immense challenges coordinating its own vast ecosystem. You've got Taobao, LME, Fresh Hippo, Tmall, supermarket logistics and data, all of which incur very high cost. And changing user perception. Getting people to truly see Taobao as a reliable 30-minute delivery platform for everyday electronics or groceries, that requires massive market education and huge capital investment. Maintaining consistent quality control for third-party sellers is notoriously difficult, as we've seen with Fresh Hippo's profit erosion when it tries to compete aggressively on price. Meituan, while dominant in local delivery, faces high operational costs in expanding its speed and comprehensiveness. Even its new ventures, like the Happy Monkey hard discount supermarkets, which demand a very specific low-margin, high-turnover, few SKUs model, highlight the inherent uncertainty of maintaining quality and reasonable prices amidst this relentless expansion. Ultimately, I believe Flash Purchase, in its current subsidy-fueled form, is a temporary painkiller, not a cure. It's unable to resolve core issues like user mindset erosion, and it risks repeating previous new retail failures we've already witnessed.
I see why you think that, and I certainly acknowledge the immediate profit pressures and, yes, the regulatory concerns you've highlighted. Those are real. However, the sheer surge in flash purchase orders, 120 million daily orders, 300 million monthly users for Taobao Flash Purchase, that signifies a crucial, fundamental shift. This isn't just about buying temporary growth, it's a strategic investment in efficiency gains like density dividends. Let me explain that a bit. When you have a high volume of orders concentrated in a small geographical area, a single delivery rider can handle more deliveries per trip. That significantly reduces the cost and increases the speed of each order. This, combined with fostering crucial cross-scenario conversions across the platform, getting someone who ordered coffee to then buy groceries later, that truly justifies these initial subsidy outlays, in my view. Alibaba's strategy of assetizing growth really exemplifies this long-term vision. They plan to disclose quality CMR metrics, customer management revenue, linking subsidies directly to efficiency via what they call the Flash Purchase 3-piece set. This includes things like non-meal percentage, unit revenue per kilometer, and average order value. They're also upgrading their mega member system to a settlement middle platform with fulfillment priority. This whole strategic direction is designed to transform those short-term gains into sustainable long-term value. Meituan's success, in turn, lies in consolidating these high-frequency demands into an incredibly effective operational ecosystem that competitors, frankly, just cannot easily replicate. Their robust delivery network and sophisticated data capabilities form a resilient moat, ensuring profitability once subsidies inevitably recede. Furthermore, their strategic focus on high-density, short-radius categories like beverages and coffee, which make up a high proportion of Taobao's instant orders too, significantly boosts delivery efficiency. This allows fewer riders to handle more orders. It demonstrates a sophisticated optimization strategy that goes far beyond simply increasing rider headcount. It's about smart, tech-driven logistics.
I'm sorry, but I just don't buy that the quality of this CMR growth is truly robust or sustainable yet. Much of what's been observed, frankly, stems from changes in billing models, not necessarily genuine organic demand or increased advertising efficiency from these new instant retail scenarios. The steep rise in Alibaba's marketing expenses, with its EBITDA, earnings before interest, taxes, and amortization, a key measure of operational profitability, significantly declining in Q2, even before the peak of the subsidy war, that clearly demonstrates that subsidies are directly eroding profits. This is further supported, I think, by the curtailment of international business investments. It suggests they are sacrificing long-term global growth opportunities just to fund these intense domestic battles. And we absolutely must question the sustainability of density dividends when user loyalty is primarily driven by fleeting price incentives.
Without a fundamental shift in user mindset, where a platform like Taobao becomes the default choice for ordering a full meal or fresh produce, not just a discounted coffee, any short-term gains are inherently temporary. That beverage-driven growth strategy you mentioned, yes, it looks efficient for logistics on the surface, but it presents significant long-term risks. Beverage categories typically have razor-thin profit margins. They have high consumption elasticity, meaning demand easily drops with economic downturns or reduced subsidies, and they can create a solidified user mindset, hindering expansion into higher-value categories like full meals or fresh produce. This risks trapping platforms in a dangerous high-volume, low-profit paradox. Moreover, these subsidies, while boosting volume, they don't magically alter the fundamental economic reality of high fulfillment costs, especially for non-meal categories, which often require precise, specialized handling and frequently have lower average order values.
That's an interesting point, and I understand your skepticism regarding the immediate financial impact. However, I would frame the role of AI in these complex operations very differently. AI-driven supply chains at JD.com, intelligent warehousing, AI-powered personalized recommendations at Alibaba. These represent long-term structural improvements that can fundamentally alter the cost curve and significantly enhance service quality in ways traditional retail simply couldn't. These aren't just, mere tactical tweaks. They are strategic anchors that redefine efficiency at a systemic level. Consider the integration of services like Gade Street Scan List into Alibaba's ecosystem. Gade, which is a popular navigation app, is leveraging its vast real-world navigation data. It's trying to shift from being just a navigation tool to becoming a local consumption decision portal. Now, this creates new, authentic traffic sources, users discovering local businesses through their daily navigation, and it intelligently reduces the reliance on pure subsidies for user acquisition. My core argument isn't that the impossible triangle is absolutely and completely shattered, but that these platforms are actively forging a new equilibrium. They are redefining what value means in the equation, using advanced technology, ecosystem synergy, and a sharp focus on LTV and data assets to create viable paths to balance price, convenience, and quality in a dynamic market like never before.
Verifiable impact on unit economics and cash flow for these specific instant retail operations is still largely unproven. Much of the optimism surrounding AI, from what we've observed, is derived more from telephone conference rhetoric than from concrete disclosed data on critical metrics. Things like average order value, actual retention rates for these new instant retail users, or the real cross-scenario conversion rates you mentioned earlier. Gao's street scan list, while innovative, serves primarily as a mindset and entry point reinforcement. Okay, it might help users discover local places, I'll grant you that. But it doesn't fundamentally transform the fulfillment capabilities or the underlying cost structure of instant delivery itself. The deep-seated user perception of Gade as simply a navigation tool makes that transition to a high-frequency consumption portal very challenging and incredibly costly, I suspect. The core issue for Alibaba, it seems to me, remains its inherently fragmented fulfillment chain. It's a stark contrast to Meituan's unified, highly efficient experience. So this expansion into low-margin, high-frequency categories without genuinely addressing fundamental challenges like stringent quality control, achieving sustained user stickiness without constant subsidies, and truly mitigating inherent profit pressures. It just means these companies are simply relocating the inherent trade-offs within the impossible triangle. They aren't actually breaking it. These are shifts in the burden, shifts in where the costs and compromises lie, not fundamental breakthroughs that redefine the rules of retail.
Okay, to wrap up my perspective then, the intensive investments and strategic realignments undertaken by Alibaba, Meituan, and JD.com, especially with this deep integration of AI capabilities, they signify more than just short-term subsidy plays. I really believe they represent a profound long-term attempt to redefine the traditional constraints of the impossible triangle. Now, while achieving a complete break might be, yes, an ambitious claim, these companies are actively constructing innovative models where advanced technology, robust ecosystem synergy, and a sharp focus on long-term user value are creating a previously unattainable balance between price, convenience, and quality. So our understanding of these evolving market dynamics must therefore also evolve, recognizing that a new equilibrium is potentially being forged, and there is certainly more to explore in how these new models will fully mature and truly reshape consumer expectations going forward.
And from my side, I remain unconvinced that we're seeing a fundamental break. Despite the substantial capital expenditure, despite the clever strategic maneuvers, the price, convenience, quality, impossible triangle fundamentally remains intact. The current subsidy war, while yes, effectively driving impressive short-term order volumes, predominantly exacerbates underlying profitability issues and crucially instills unsustainable user expectations. Without verifiable improvements in long-term CMR quality, sustainable unit economics, and a genuine lasting shift in user mindset, one that's independent of temporary subsidies, these companies are, in my view, merely deferring the inevitable confrontation with those enduring trade-offs. The true winners in this fierce competition, at the end of the day, will ultimately be those who can establish financial stability and a clear, distinct user perception after the subsidies inevitably recede. Not necessarily those who achieve the highest, but potentially unsustainable short-term order growth right now.